I've been investing for 12 years using a strategy that takes 5 minutes a day. In this video, I'm going to show you exactly how it works, what returns it produces, and why it's the simplest path to actually retiring early that I've found. The old path to an easy and early retirement was to work really hard during your career, put money into a pension every month, and then retire with a great income that's going to sustain your lifestyle. Now, bad news, that day is gone. A normal income that's been put aside for a pension isn't going to be enough because things are getting a lot more expensive at a rate faster than pensions are typically growing. So for example, this would be called inflation. So really simply, inflation is how much more expensive things get each year. The Bank of England will tell you inflation is between typically 3 to 4%. Now you tell me this, when was the last time you went into the grocery store, looked at your receipt and thought, oh, things have only got 3 or 4% more expensive this year? It doesn't happen. Things that used to be £1 are now £1.50. Things that used to be like £5 are now maybe £7 or £8. Like things are really jumping in price. So I think that 3 to 4% number is absolute nonsense. To be honest with you, I would say to really be keeping up with inflation, your money needs to be making at least 10% a year profit just to stay equal. Now, when you hear 10%, you might think, oh, well, that's an amount, but it's probably not going to make too much of a difference. You've got to remember compounding. Now, compounding is a really misunderstood concept. If everything got more expensive just 10% a year, in 15 years' time, things are 4 times more expensive. So something that was used to be £100, in 15 years' time would be worth £400. People are making like 3% a year on their pensions right now. That's insane. Nothing's only getting 3% more expensive. So with that in mind, you need to be making a lot more. And the way to do that, the best way I found, is to have investments that you have full control over. Now, the great thing about having investments that you have full control over is that you decide exactly where they go, what you choose to specifically invest in, when to buy, when to sell, to make the best results for you. When you give all of that money to like a pension fund or an investment fund to manage it for you, you lose that control, and honestly, you make less in the long run. You can do better than the professionals. And I'm about to show you how to do that. Having been investing for 12 years myself and having taught thousands of people how to invest as well, I know that over a period of up to 10 years, you can make an insane amount of extra income that's going to supplement any retirement plan that you have. Now, the way I do that is by teaching the strategy that I created called the VAX strategy, VAX. And I'm going to walk you through the framework itself right now. So on here, you can see we have the 3 stages. We have value, we have averaging, and we have extra. We'll start off with value. This is the first step here. The first thing I'm looking for is this company I'm investing in a valuable company? Is it fundamentally strong? Is this a company that no matter what happens in the world, they're going to be okay? Because I believe that in what you choose to invest in specifically is the most important factor in your success. If you pick a bad company, even if they're having a good day, you're probably going to end up losing money. Whereas alternatively, if you pick a great company, even if they're having a bad day or a bad week, they're probably going to be okay in the end. Like for example, if I told you to put £100 into Google today and then tomorrow Google starts to drop in price, you're probably not panicking that Google's going out of business. So what you invest in is the most important factor. So this is how I do this here on this value section. The way I like to do it is by doing what we call fundamental analysis. And fundamental analysis is looking at the numbers behind the company. I'm not worried about the news stories, all the blogs online, or listening to Bloomberg or whatever nonsense people do to make investment decisions. I'm only interested in the facts, the data. How much money is this company making? Like, what debt have they got? What's the size of the company? Like the real important information. Logically, that probably makes sense to just base your decisions on facts. So that's why I do it here. Now, where it says my criteria, the criteria I've created is called the fundamental 13. And this is a set of 13 specific criteria that I've found out that using the VAX strategy, if a company meets all of my 13, I would invest. If it doesn't meet them, I wouldn't invest. It just keeps it nice and simple because everything's just yes or no. It's black and white. There's no gray area there. So that just makes investing really fast because a company either does meet your criteria or it doesn't. So that's how I do this. Now, just by following that, it already filters out around 99% of companies out there, which makes my selection a hell of a lot easier. Once we've then decided what we're going to invest in, this moves on to the second stage, which is averaging. Now, averaging in a really simple manner is a fundamental principle of investing. It's as old as time. And essentially it means not putting all of your money in one go. Because this is what a lot of beginner investors do. They say, right, I've got £1,000 to invest. I want to invest in Microsoft. So they buy £1,000 worth of Microsoft. Well, what are the 2 things that can happen there? It's either going to go up or down, isn't it? And if you've put all of your money in, you need it to go up. Now we know at least 50% of the time, you're going to be wrong and it's going to drop, right? So if you've got all your eggs in one basket, at least 50% of the time, you're going to be screwed. So instead, what it's better to do, and what I choose to do, is split my investment into chunks and invest in chunks at a time at different prices. So that I'm going to buy a certain amount of stock at this price, and then if it goes up, great, quick profit. But if it goes down, at least the other 50% of the time, I can buy more at a cheaper price. And if it goes down any further, I can then buy some more at a cheaper price. So if the stock keeps dropping, I want to keep buying it because it's getting cheaper. It's the same company, just at a better price. So what I do then is I say, okay, well, I'm going to buy as it drops, but how much do I buy at each stage? How much money am I going to invest at each increment? How many increments am I going to invest in? Is it going to be 3? Is it going to be 4? Is it going to be 5? Okay, depending on the company. And all of this just to make sure that you've got a plan no matter if the stock goes up or goes down. So hopefully already you can see how that's very different to just throwing all your money in and hoping for the best. Then once we've decided what we're going to invest in, we've decided when we're going to invest and how much we're going to invest, we're obviously invested the money. And this brings us to the third stage where we are really looking now about exiting the investment, which is about, okay, well, how much profit are we going to leave with? So I am what I would consider quite a low risk investor. I've tried all the risky stuff before myself, and I'll be honest with you, most people do not make serious money long term when they're taking high risk. They think, oh, high reward, I'll get rich quick. Well, high reward also means high risk, right? The downside is as big. And often people do pretty well, big loss, and they wipe themselves out. Now, if you're planning for your future, you don't want to be taking big risks like that. You need to secure it. So I think going for a more lower risk approach, more steady approach makes a lot of sense. So when I am in profit, what I do is put in what is a safety net, essentially. So it's really called a stop loss, which you may have heard of. But essentially, a stop loss is designed to stop your losses, as the name suggests. But what I'd use it for is when I'm in profit, rather than saying, oh, that's enough profit, I'm going to sell now, which is just an emotional decision, right? Who am I to say that's enough profit or not enough? It is silly. Instead, I put a safety net in and say, okay, well, I'm in this amount of profit, here's my safety net. If the price does fall, well, it's going to hit my safety net, sell my shares automatically, and I'll get my profit. Great. Or alternatively, the price keeps going up. Great. I can keep bumping up that safety net, right? So it's a much more methodical way to secure your profit. And it also removes the emotions from the decision making. Emotions and logic don't typically mix when it comes to investing. So you want to make sure you've got a system that you know what to do at every single stage, no matter how you're feeling that day. When this happens, I do this. So this VAX strategy was actually born out of necessity for me. So I used to be a full-time trader, which essentially a full-time job, staring at my screen all day, watching lines go up and down for hours. Not my idea of fun, probably not yours too. I didn't want that anymore, but I didn't want to lose the income. So I created this strategy that takes just 5 minutes a day, just to get my life back. So I could have all the time freedom I could possibly want. Now, this is the strategy I teach to many, many people so that they can get that too, because most people want more income. They want to know that their future is secured and not just focused on just their career itself, but they don't have the time or maybe even the experience to want to go and invest themselves. So that's why this is so important. If this is making sense and you want to see how we implement this inside a structured program, that's exactly what the Trade Tribe is built around. You get the full VAX framework, live weekly sessions with me, and a community of people working towards the same goal. Before any of that, I want you to come along to the free masterclass so you can see it for yourself. The link for this is in the description. Let me keep going. So now let's talk returns, because let's be honest, that's the real reason you're getting into investing, because you want to make money. This is what you can expect using the VAX strategy. What I find really interesting is people think that making a really decent return each year is either impossible or can only be achieved by taking really big risks. Honestly, the opposite is true. The only way to get consistently high returns is to take a steady approach and slowly build wins on top of each other, rather than trying to go for the big wins, big volatile losses as well. This is how we do that and what it looks like within the VAX strategy. When people hear that on average people are making around the 40% a year mark, they think, how on earth could you possibly make 40% a year? The stock market only moves 10% a year, blah, blah, blah. Well, one part of that is we're investing in individual stocks rather than just the entire market. Now, individual stocks move a hell of a lot more than just all of the stocks. Rather than just trying to shoot for, let's say, 30 to 40% in just one big investment, which would be pretty cool, don't get me wrong, but probably not that common. Instead, we want to make smaller investments throughout the year. When you add them all up together, they do create 30 to 40% returns. For example, I like to have 5 investments at a time, 5 individual stocks. Well, let's say on those 5 stocks, on average, each takes 2 to 3 months, typically my average is to get into profit. Well, I only need to average 10%, maybe 15% on each of those. That's what I aim for. So maybe I'm going, 10 to 15 on each. Well, let's say that takes me 3 months on average. Well, if I do that 4 times a year, those 10 to 15% start stacking up quite considerably. And it's very simple to make 10 to 15% on a stock because they move quite considerably. So as long as I'm stacking those smaller wins on top of each other over the entire year, that compounds to a lot. Now, you can probably tell me that just making 10% a year several times is a hell of a lot more achievable and realistic than trying to make that big win in one go. But let me show you how this actually grows it. I'm gonna get the calculator up on my phone here to show you. So let's say we go lower end, let's say 30% was what you made. So let's say you had, I don't know, £10,000 to start with, just for a round number. Well, you making 30% a year, so if we times this by 1.3, that would be 30% profit. After the first year, obviously that grows to 13,000. But as you then make the second year, that grows to 16,900. We've already made like 7 grand of profit here. You can see how this is growing. That's after 2 years. So then we've got 3 years, 4 years, 5 years, 6 years, 7 years, 8 years, 9 years, 10 years. We're at 137,000. Starting with 10,000 to 137,000 by just making that 30% a year. That's how the compound effect works. And in my opinion, it's the only way you're going to build long-term wealth that's going to improve your lifestyle. So using the VAC strategy every day means I'm not sitting there reading the news. I'm not there listening to Bloomberg. I'm not there with the Financial Times scouring the articles that are in there. No, all I'm doing is following a very strict process because I know if I follow the same process consistently, I'm going to get consistent results. So this entire video has been about you achieving the retirement that you want. So I'm actually going to set you a task right now. Firstly, I want you to think, what monthly amount would you need to cover all of your expenses today? What would you need to be bringing in every month to cover your expenses to continue your life as it is? Have a little think what that number would be. Now, I next want you to think, how much is that going to be when you retire? As we said, we know everything's only getting more expensive. So are you looking to retire in 5 years, 10 years, 20 years, maybe even 30 years? How much more expensive are things going to be then? Is it going to be twice as expensive? 3 times, maybe even 4 times as expensive as I think things will be in the next 15 to 20 years? Whatever number you said would cover your monthly expenses, you need to times it by 3, 4, just to get a realistic number. Now, whatever number you're left with there, that is your target for investing. That's what we want the VAC strategy to be paying you each month so that all of your outgoings are covered and you can live the life you actually want when you retire and you're not stressing about not having enough. Because let me get real with you for a second. The people who have a great retirement are not the people who earned the most necessarily. They're the people who started investing early and kept consistent with it throughout their career. If you're getting towards the end of your career and thinking, oh my God, I wish I'd started sooner, don't worry because that time's gone. The best time to start is now because then you can build more and more for your future. If you're fortunate enough to be a fair few years away from your retirement, well, great. Starting investing now means that you're going to make a huge difference to what life will look like when it is time to step away from work. But the key to all of this is just to start. The thing about investing is it does need time to grow. So the best time to start is now. Look, nobody ever wishes they started investing later in life. You never hear that. Everybody says, I wish I started sooner. So really you have the decision. You can either keep putting the money aside into a normal pension, letting it grow at 3 to 4% a year and just hoping that that's going to be enough, even though you know things are getting a lot more expensive. Or you get to take control, keep doing what you're doing, but add this on top of it so that you know I've got more security, more freedom, and a lot more choice in my future. Because I promise you, when it gets to the time to retire, you are not going to regret starting investing earlier. The pension isn't going to give you the retirement that you want. That's not pessimism, it's just the maths. But investing consistently, using a clear system over the next 10 years, changes that picture significantly. The free masterclass in the description covers the full VAX framework and walks you through how the Trade Tribe works. It's free, and by the end of it, you'll know exactly whether this is the right fit for you or not. Subscribe for more content like this, and I'll see you in the next one.